to the fundamentals of cash flow forecasting. This has been a special interest of mine, both as a Treasury executive and consultant. I've had 30-plus years of experience with cash flow forecasting. I've evaluated and revamped many cash flow forecasting systems. This course is intended for the beginner or someone who has taken over a forecasting system and wants to be sure the system is effective or needs fixing. We'll take a look at broader issues and begin to explore different methods and approaches. Our focus of this course will be on the short term. Senior financial executives have identified cash flow forecasting as a problem area for many years. A recent survey indicates that over half of them question the reliability of their forecasts and feel this is an area that needs improvement. In my experience, I have found that senior executives do not have clear-cut evaluation criteria. Their dislikes are vague. Many just note that they don't, quote, like their forecasts or trust the Treasury managers who prepare the forecasts. Of course, this makes it difficult to revise and improve the system. In one case, a consulting client discussed its forecasting problems with me. The treasurer told me that it was often, quote, way off, unquote, and wondered if I could build a model to replace the current method of gathering data from numerous sources. He also expressed his unhappiness with the preparer. I told him a model was possible as they had more than enough data that seemed predictable to me at first glance. My discussions with the preparer and a few sources, however, turned up a different problem: communication. The preparer of the forecast received data from the sources, but never reconnected with the sources when their estimates were off. This was because the treasurer forbade it, not wanting to, quote, bother the sources, unquote. So I offered him two choices: allow two-way communication with variance analysis or use the model I'd built. He chose to do both and was happy with the result. In instances where the forecast is not well regarded, senior executives impatiently try to fix the system quickly, or they may just ignore it and ignore the forecast. Based on my experience in discussing forecasting problems with Treasury staff and senior financial managers, I see a distinct difference between what is expected by management and what is possible by staff. I call the former the irrational expectation zone, and the latter the best the forecast can do. Obviously, the wider this gulf, the more difficult it will be to resolve the difference between actual and desired and to develop an effective system. This figure shows the normal cycle for most forecasting systems. It typically starts when the sources of the forecast data send their estimates for the forecasting period or periods. Note, the sources are usually people, but they could also include other company systems. The data are compiled and reviewed by the preparer of the forecast. This gives the preparer an early vantage point to be able to question data or follow up with sources that have problems so the forecast can be changed. From there, the forecast is prepared and compared with actuals. This produces variances between the forecast and actual data, and these variances can be shared with sources to correct any errors or misunderstandings. This applies to people or systems. Someone has responsibility for the data input, so that would be the appropriate place of contact. An approach I have found useful in managing the expectations for a forecasting system is to answer three fundamental questions. 1. Can you really call your, quote, hunting and gathering, unquote, a forecasting system? Much of this depends on the performance of your sources, so you need to objectively evaluate them. If you don't see a system, it probably doesn't exist. What are you trying to forecast? This is harder than it sounds. I have looked at many systems and wound up scratching my head because I couldn't figure out what the forecast was supposed to be predicting. There may be lots of numbers, but they should say something. For instance, it is important to predict cash flows or to develop a model that reflects cash flows, not just cash, because the cash figure is the net result of the cash inflows and outflows. Many financial managers lose sight of this important difference. Why are you doing this forecasting? If it's for you, you should have a good idea of what you need and whether you're getting it. If it's for others, you'll have to find out what they're looking for and whether they're getting it. Bad forecasts can be worse than no forecasts. However, you really cannot function without a forecast. There are several effects of bad forecasts. If you experience one or more of the effects shown, you will need to take action. The primary impact is felt in your working capital. Creating uncertainty in how working capital management is handled can place a heavy financial burden. You become very limited in how much you can finance or even expect to receive on a regular basis. You'll get too many surprises. As a result, your short-term investing and borrowing may be compromised. You tend to invest for shorter maturities, sacrificing yield, or borrow unnecessarily, thereby increasing interest expense in the process. If you are a heavy borrower, you can expect a lot of pressure from senior decision makers calling for an accurate short-term forecast. You may also discover that there are excess funds in local accounts sitting idly because no one tracks them. Finding idle local funds can prove an unexpected cash inflow when they are discovered and transferred to a point where they can be used. Overall, your management of working capital suffers and penalizes the company, preventing fast actions on attractive financial opportunities or getting hit adversely by changes in short-term rates.